And it says we are now streaming on Facebook.
Ooh, we are. Watch live video. So do I have to click? Okay, I know you guys. So
welcome everybody. I think we are live now. So welcome to this week's Talk Me Off the Ledger episode. I'm Jacob Schrader from Ascend Consulting, here with Beth Melcher from MoneyFit and Amy Walker from Walker Agency. Today,
so first things first.
Go Beth.
We had a very special event this week. I think someone whose birthday I totally forgot, didn't even know it existed. Was it your birthday this week, Amy Walker?
It was, and the sad thing is, it's already, I've already forgotten that it was. I was like, oh, really? It was Jacob's birthday?
Amy Walker!
Yeah.
Happy birthday, Amy.
Thank you. It was good. It was a good day. I love having a November birthday because it's nice and cool here in Houston, and so, that makes Houstonians happy.
Okay. That first things first, the people.
Had to get, yes, it's the most important thing.
Happy birthday, Amy.
Thank you, dear. Yeah, exactly. All right. Talk me off the ledger, friends. What are we talking about today?
So today we're going to talk about why your bank won't lend to you. So, and we decided to do this right after some of the balance sheet things, because balance sheet is one of the most important things of lending, I feel like. So Beth, why don't you kick us off and kind of explain to us why what lenders look for when they're going to lend to a company?
So in my background, I used to be a banker, commercial real estate and private banking for banks in Michigan and banks in Ohio. And as a relationship manager, we used to have to do loan write-ups. And primarily we would look at a few things about the business and about the business owner in order to determine if they're worthy of credit. And to go all the way back to, the bank's number one responsibility when it comes to lending money. They are responsible for taking funds deposited by their depositors, to be redundant, take very good care of that and lend it out only when it makes sense. So it's not really ever the bank's money, it's the depositor's money. So their requirements and they should be sticky about whether or not they lend money to people. So I just wanted to say that first, because your money's on deposit with them. You don't want them investing in, junk bonds and having, go back to the bank and have that gone. So primarily, it is going to be the net operating profit and loss, essentially, of the business itself. They want to make sure that if you take on additional debt, that you can afford to do so. And Jacob, I know you're going to talk a little bit more about the types of loans, but primarily they want to make sure that you can service the debt. They do a calculation called a debt service coverage ratio. We don't really need to define what all's in that at this point, but they look at the extra cash that you're generating from your operations and deciding whether or not you can afford the debt. The next thing they look at, do you want to do,
I want to ask real quick, that debt service ratio, I know we don't want to get into detail number crunching, but what are some large factors that go into that calculation?
Jacob, why don't you do that? I mean, you've been working with the banks so much in PPP. I don't want to do all the talking.
I mean, the most important, the principle behind a debt service coverage ratio is saying, okay, what are your debt payments each month? So if you have $10,000 of loan payments you have to make each month, do you have enough net income to cover those, right? Like, can you actively cover the debt? And that's why it's a debt service coverage ratio. I mean, if you have made $10,000 in profit and all of them went to debt, the bank's going to say you don't have enough to service your debt because there's going to be fluctuations in cash flow. There's going to be things like that. So, they want a ratio, and every bank's targeted ratio is a little different, right? And depending on how risky they feel it is, those ratios change. But that's the principle behind the debt service coverage ratio is, can your profits support the debt you have on your balance sheet? And these become a little interesting when you start factoring in like lines of credit, which don't have an active repayment schedule, right? It's not like it's getting paid on a monthly basis every time. So different banks treat those a little differently on how they're impacted in there and how they weight those items. The other things is like you have variable interest rates, okay, what does that mean for this? You know, how does those impact things, and how do those impact your P&L? It can matter as well. So why we say the balance sheet is super important, we are looking to cover the balance sheet debt with a P&L. So the P&L is still important, but frankly, if you had no debt, then now your debt service coverage ratio is infinity, right? Because you have no debt and you have income. So balance sheet is super important there, because if you get too debt heavy, you can never make enough income to service your debt. And that's where you have to watch this. And so that's the big thing about debt service coverage ratios.
Okay.
I see them at like 2.0, like between 1.5, 2.0. So what that would mean is if you, now I know that bankers are gonna be like, that's not what's in our calculation, but roughly for the folks at home, take your income, cost of goods sold, all your overhead expenses, don't include your interest expense and principal payments yet. Taxes, I don't have those factored in. So don't include depreciation, so EBITDA, earnings before
EBITDA,
interest,
yeah.
taxes, earnings before interest, taxes, depreciation, and amortization. Use that number and then pull together what your interest and principal payments are, and take the EBITDA, divide it by your debt payments, which is your principal plus your interest, and that equals your debt service coverage ratio for the most part.
Okay, so
Post here if you want to argue.
To be a proactive debt shopper, you would know your debt service ratio before contacting the lender. It's like kind of like being pre-qualified for a mortgage. I mean, you know what you're getting. You're not just blindly walking out there and saying, oh, so-and-so give me some money. You're prepared. You know what that ratio is. You know your financials are in great shape to present them. That way you have more leverage when you're going and looking, when you're shopping for debt.
Yeah, well,
Okay.
my opinion on, if you're going to go out and buy a piece of equipment, you need to be thinking about what income uptick am I going to get by putting this equipment into place. Hopefully it's not just straight replacement. Assuming, maybe you're extending your manufacturing line, so you're buying equipment. What income increase am I going to look at? What increase in staff, cost of goods sold, other materials, anything to overhead that's going to change as a result? Look at the cash flow at the bottom to make sure that the additional debt service that you're going to incur by buying that piece of equipment makes sense before you even do debt shopping. Now, lines of credit, Jacob, I typically make sure, like when we were bankers, we'd make them rest for a while. What do you bump into in Ohio?
Yeah, I mean, it all depends upon your line of credit, right? And this is actually an interesting conversation. Like, if we have a line of credit that is collateralized, sometimes they don't make it rest, right? But if you have one that doesn't have a solid collateral period, then typically they want 30 days of rest every year, right? So that means your line of credit has to be at a zero balance for at least 30 days every year. If we do a real estate secured line of credit, sometimes they're like, oh, well, we only have to relook at that every 10 years. So they're not requiring that rest period as often, right? Because now it's collateralized with real estate. And I guess that's an important piece when we start talking about loans, is there are collateralized lenders and non-collateralized lenders, right? So collateralized lenders are lenders who only lend if they can do a UCC filing on a piece of equipment or a property. So a UCC filing is basically saying, hey, if the borrower does not repay these debts, we get to seize these assets, right? And we now own these assets. Perfect example of this is a home mortgage, right? UCC filing happens. If you don't pay it back, they get to seize your home, right? Same thing in business. We can do that with individual pieces of equipment. You can have blanket UCC filings on inventory, on AR. There's a lot of different factors that they can do. So like when they do, or they can do a blanket equipment UCC filing, which means any equipment you own is, even though it's not named necessarily in the UCC filing, they can claim all of it if you don't repay it.
Right.
So
have you ever seen that happen? Have you ever seen a business, they come and seize possession of their inventory?
I have not seen inventory alone. I've seen equipment for sure. And property.
My favorite story, there are these fleet loans that banks can do that they essentially are financing the cars before they're sold for the dealerships. And bankers will always say, well, the last thing the bank wants is your inventory. They don't want it. They don't know what to do with it once they get it because they have to fire sale it. But they're like, the worst lien to have anything on is something on wheels because right before they can go in and get their inventory, it rolls away before they can claim it.
Well, and that's the thing. Typically, banks really try to work with people on inventory because normally the business is better situated to sell that inventory than the bank is, right? So the bank is very incentivized to go to that company and say, you sell it at a 20% discount, or even a 40% discount. Because if we take it on, we're probably selling it at a 90% discount.
Yeah.
Because it's just straight fire sale. So typically banks are really incentivized to work with you on inventory and even equipment, but not as much equipment. Real estate though, I think we've all seen they like to take real estate when they can, right? So that is collateralized lending. And then there's uncollateralized lending, which is the bank has no guarantee at all, right? And not all banks will do uncollateralized lending, but basically this is lending upon your name, right? They're lending it based upon the reputation of the business, of the reputation of the owners. And so you have collateralized and non-collateralized, and then you have another factor out there, which is personal guarantee or not. So in small business, many times bankers require the borrower to put up a personal guarantee. So even though my LLC, which has limited liability to me, is lending, the bank says, because that limited liability is there, we want you to personally guarantee it, which means the LLC folds, goes under, can't repay this. They're going to come after you personally for that debt, right? And that is that personal guarantee. And that happens in collateralized and uncollateralized lending, right? You know, this is basically like, I just personally guaranteed it. So now they can come after my personal house, they can come after my personal assets, et cetera, if the business would fail. Typically, and I would love to know your experience in this, Beth, like we see first 5 years for sure of a business, typically a bank is always going to require a personal guarantee. Like very rarely under 5 years do you get away with not requiring, not having to give a personal guarantee. Once you start getting some age on your business and some maturity, it becomes a little easier for the business, which now has a business credit report, to get non-personalized, non-personal guarantee lending. But typically in that first 5 years anyways, I'm trying to think if I've seen a case where a bank's been willing to lend without a personal guarantee in those first 5 years.
My children are home from school and they're opening the door. I'm like, oh, wait, be alone. They're always going to ask for a guarantee. They're always going to ask for collateral. A lot of it's going to be the power of the individual to draw a line in the sand and say, I'm not willing to do that. But you've got to be willing not to get the debt then. Personal guarantees on just about everything, unless your equity position is looking really strong and it's highly collateralized. I think, I don't know how much time we have left, but something I want to think about, because I've seen this a lot, is the use of lines of credit for fixed assets. The use of lines of credit for things other than cost of goods sold or materials for the business or short-term cash shortfalls that won't be rectified in the long run. I think it's super dangerous to use a line of credit for something that you intend to pay off over a long period of time, because that is not its intent. And you can really get yourself in a tangle, because if you have a $125,000 line of credit, you buy an $80,000 piece of equipment, you're not going to have any room to borrow when it comes time to buy materials, or COVID hits and you've got a shortfall and you're out of PPP money. So, and because you can't pay your employees on a credit card.
Yeah.
Oops, go ahead, Jacob.
No, go ahead, Amy.
I wanted to segue into, it's not necessarily a form of debt. It's a 30-day float for people that cannot collateralize a large sum of money in their personal name, but I don't want to change topics before letting you finish, Jacob.
So I was just going to say, obviously we talked about debt service coverage ratio of why banks won't lend to you. If you can't meet that debt service coverage ratio, another big piece of that is if you don't have enough collateral, and they're looking for collateral, right? Like I want a $3 million loan, but I only have collateral of $500,000 in assets. That's going to be rough for a lot of banks to lend that, right? Now, I'm not saying there was not banks out there, but you're going to see very different interest rates on non-collateralized lending. You're going to see more venture style debt Instead of venture capital, there's like venture debt, which is in a typical banking relationship. So, as you're going in there and saying, will my bank lend to me? Debt service coverage ratio is super important. The risk of your industry is super important. Like they're going to say, is this a risky industry right now? And I think this is coming in a lot of play, especially now as we go and look at people trying to go get loans right now.
Mm-hmm.
Banks are what industry isn't risky right now, right? So you're starting to see potentially some of those debt service coverage ratios starting to creep up. You're going to start seeing some changes in that world probably, which are going to impact your ability to lend. The other thing is, even after you get your loan, you need to be aware of your debt service coverage ratios. So some loans have covenants in them.
Mm-hmm.
You have to meet certain covenants, and debt service coverage ratio isn't the only one, but there's many covenants. And I think we're going to see a lot of businesses in breach of their covenants this year because they're going to show a loss. And if you have a loss, how do you meet a debt service coverage ratio when you've lost $50,000, right? If you have an EBITDA of negative 50 and you have debt payments of $50,000 for the year, we have a problem, right? In the bank's eyes.
Yeah.
And now your risk just went through the roof. And the fear of mine in this is many of those bank covenants, they have the ability to call the loan immediately if you don't meet those covenants. So we could see businesses that due to PPP, due to other things, right? The EIDL loan, et cetera, they've gotten lending to help them float along. But if their loans get called immediately, they are not going to have cash to bridge that gap, even though they may be on an upward trend now and they've recovered fine. So I just want to throw that out there. This is important even after you've gotten that loan to maintain those things.
Yeah, you've got to check your loan documents and take a look at it. So examples of covenants that could be written could be anything like restrictions on capital expenditures. They may have maximums that you're allowed to distribute to the owners or shareholders. So they will be outlined in the document, your loan agreement with the bank. It'd be a good idea to go through it. When they do the calculation for the collateralization of the loan, there are, if anyone likes to do these calculations, there are loan to value ratios that apply. You can talk to your bank. There are percentages, maybe accounts receivable, they'll lend 75% against the value of accounts receivable, maybe 50% against the value of equipment, never 100%. There'll be always some percentage applied. And above all, I think having a really strong relationship with your banker, do it, meet virtually now and make sure that you guys talk about covenants and whether or not there are any. I always say this, the human can help you a lot more than the software or the internet interface. So it's like being a teacher's pet. Your grade's going to be a lot better. I was never that, unfortunately, but nurture the relationship for sure.
Yeah, I think we all learned that during the PPP process. The thing that your dad and your grandpa told you about know your banker, well, it all circled back. I agree with that.
Amy, you had a question, didn't you? I feel badly.
No, I think I want to save that for a future episode because this has all been good information, and I think we could make a whole episode about where I was going. So I'm gonna hang on to that thought.
All right, so our 15 minutes for the week is up.
Oh no!
But, yeah, so glad to see everybody again. Amy, want to give how people can reach out to you?
Sure, we are Walker Agency, walkeragency.us, and on the socials we are WA1 instead of L, KER Agency. You can find us that way.
Beth Melcher, I'm at MoneyFit. The email or the URL is BEMONEYFIT.com, bemoneyfit.com. And then Instagram is at BEMoneyFit as well. See you there. And
I'm Jacob Schrader. My Twitter is Jacob B. Schrader. And our URL is ascendllc.co. So it's good to see you guys all today.
Bye, guys.
See you next week. Bye.